All right, we're live. Here we
We're live.
go.
Here we go. Hey, everybody. Welcome to the High Ground, episode 3. This is a Pacific Northwest conversation. We're talking about markets, we're talking about retirement behavior, and we're talking about investing for the long game. My name's Andrew. I'm here with Will, and I'm wearing a sweater in July.
Wow. Wouldn't have seen it except as an Oregonian, you got to expect it. Key topics we're going to talk about today. We're going to talk about stock market, mid-year check-in.
Mhm.
We're going to tie it into Spain and Argentina's unprobable wins this week. We got Pacific housing markets, and we've got to also we're going to conclude with why order of your investment returns really matters. And so let's go ahead and kick it off with
Jump in.
maybe a half-year check-in.
Halftime report, maybe?
Halftime
CNBC?
report. I feel like that one maybe already has is already reserved for some big name institution. So we'll go ahead and call it half year check-in. We'll
Let's
we'll
do
play
it.
with that. But yeah, pretty incredible start to the year despite headlines, right? Our headlines have been what's been going on with the Strait of Hormuz mostly.
Mhm.
We've got some polarized political views. You've got all of these things that seemingly are muddying the water. Yet going through the first 6 months of 2026, S&P 500 is up 9.6%. We've got this great chart done, provided to us by Deutsche Bank that shows just over the last period of time, the key performers. So we've got small cap US companies up. Russell 2000, which is small and mid-sized companies, up. Nasdaq 100 tech companies, up. S&P 500, up. Even like a more equally weighted S&P 500 is up. What's not listed here on this chart? International, which is doing incredibly well as well. The only thing that this chart highlights that is down, which is I think pretty surprising, is what is known as the Mag 7 or the Magnificent 7. So collectively down over that same period of time. And so for the
I
past
think
few
most
years,
people would have got that wrong, Will, which
I, well,
which
I,
is
I mean,
which
I
is
would have
which is
absolutely got
crazy.
that. I would have got that wrong. If we're
Yeah.
starting off January 1st, that is not on my bingo scorecard.
No.
And so you've got companies like Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla. Like these would have been like the obvious leaders in my book. Like if you're compacting them all together, some have performed decently well. Um, but what we've seen over the last couple of years is those companies have been carrying the weight of the entire market. Almost feels like it's kind of dragging it upward.
Yes.
When to start off the year, we're seeing a very different thing where we're seeing more of this rotation. And I think there's a lot of encouragement from that. I think rarely is it a good thing for a few companies to pull the rest of the market. There's an adage of just like this idea of like a rising tide lifts all ships, as opposed to like a tugboat being able to pull the boat down the river, which we see a couple times here in the Northwest. But yeah, the encouraging piece there is that narratives can change, yet the stock market can still go up. And so I think about that every year, you and I and our team here, we talk about like, okay, what's going to happen this week? What's the most probable outcome? And I think a lot of prognosticators across the world do the same thing. And I think there's a dose of humility here that things can change pretty quickly. Narratives change, but the stock markets can go up.
And I feel like, well, where it's these, 2025, 2026 years rhyming a little bit together,
Yeah.
where in this kind of healthy dose of, oh, here's what investing in the market looks like from a risk standpoint, where we go back to last year, if we took put ourselves in the spring of 25 or like peak tariff volatility,
Yeah.
you know, terrifying in the moment from a market perspective. Big reactions. You and I are like jumping on, listening to podcasts, going and seeing like economists. What's this all mean?
Yeah.
And then 2026, where it's okay. Here's price of oil, like you mentioned, Strait of Hormuz, war in Iran, and from a market perspective, this dose of volatility as well. And those things happening at similar points in the year, I think if those didn't happen and we're at these market levels, I think people are feeling maybe a little bit more toppy than they otherwise
Mhm.
would. Having that volatility, both springs, I think provided these areas of conversations for with us and clients, or just investors in general about, okay, here we made it to this point, but it wasn't just this straight line up.
Absolutely. Yeah, I think anecdotally, like I'm not talking to many people that are overly ambitious about the market, right?
Yes. Yeah,
I
you
think
can see
people
these
are,
like sentiment,
yeah,
like
I think people are
thermometer
like a
charts.
little bit timid
Yeah,
about this
yeah.
world, right? So. No, absolutely. But yeah, I think a rotation away from these magnificent seven companies is probably healthy. I think the market being supported by more companies is healthier than one just supported by seven names. But I also think right, we're students of history, we're students of the market, and something that you and I have looked at together is how market leadership, that rotation of those top companies, is pretty consistent in history. So there's this great chart that we'll share from JP Morgan that highlights just what are the top 10 biggest companies in the S&P 500 by market cap and ultimately looking at over the last few decades how those have changed. So even if we look back to just last year, there's been a couple of new names added. So Eli Lilly, a new
Mhm.
one, Micron, a new one. But other than that, that's just after a 1 year change. But the if we look back to 2015, really there's only a few names that remain. Then that's JP Morgan, Berkshire, Apple, which are no longer part of the top 10, but they were last year. So after a decade, those were the only ones that continue to remain. But I think it's just a good reminder that where it's really easy to be like, well, these are the biggest and best companies. I need to invest in only those companies. Why would I own anything else? Well, I think time would tell that that could be a fool's errand and can oftentimes, like the rug can be pulled out from underneath you. I'm not calling a changing of the guard today,
Yes.
but I do think it's pretty normal.
What's interesting about this too is it's like we've had conversations with folks like I think about, pre-COVID kind of that like FANG. Th Those were those really popular years of like we're getting calls and saying, hey, like let's just invest in Facebook, Apple, people would throw in like Netflix into that too.
Yeah.
And it's just like let's go and just invest in a few companies. And this is a really important chart because okay, like that could be an awesome investment. However, this changing is normal.
Yeah.
And also the other piece is we'll have conversations where, oh man, especially in this 25 to 26 where we're seeing top 10 companies are making up like 40% of the market cap of the S&P, that can
Mhm.
feel comparatively top heavy. That can feel comparatively like, oh, am I really getting the diversification I need? When we look at that compared to global markets, we're in just different, whether it be, in Europe, whether it be in South Korea, et cetera. This is a version of normal globally. And so we don't get overly concerned saying like, oh, this has changed from like if we're looking at the chart, 18% in 2015 of these top 10 companies market cap to
Yeah,
39, 38. That's actually becoming more normalized globally.
absolutely. I also think about just like what these companies represent. Right. So Amazon is on that list as a top 10 biggest company. And I just think about all of the companies that a company like Amazon represents, where, right, Whole Foods, like I see them delivering groceries. I see the Amazon trucks driving in circles around my neighborhood, right? Oftentimes, like making some stops at my house as well, right? Maybe too many. But just the recognition, like they are a pharmaceutical company, they are a grocery store company, they are a delivery company, they are, and not even talking about just like their like the data side of their space.
Yep.
And I know you've got some good friends that are at Amazon as well. But my point there is Amazon is not just a energy company, not just a book sale or seller anymore, right? They represent so many different segments. And so when we think about like that top heaviness, it's a representation of a lot more industries than just one or two.
Yeah,
Um,
can you have diversification within a few different organizations? For sure.
maybe,
Can
yeah,
you?
absolutely.
A funny Amazon anecdote is, you know, I was learning about some of the like these A/B tests that they do, and it's like, oh,
Yeah.
if you go and you look at the price of something on a individual basis or per unit basis, and that can be $100 of million decision of
Mm,
just, oh, here's what you see like when you go and you click on that and how that's viewed to you. So yeah, it puts that in scale
yeah.
of oh, these things are massive.
Yeah, yeah, absolutely. So, no, these are good charts to start off the year. I mean, it's hard to complain when portfolios are up.
Mhm.
Even well-diversified portfolios are up. And so when I think about like the global diversification aspect, like this is a great time to remember like why we do what we do from a diversification standpoint. And part of the great thing is like you don't have to guess what's going to happen next,
Yes.
right? You don't have to guess the downturn of the Magnificent Seven, whether this is just a blip on the bigger picture or this is a part of like a ongoing trend. You don't have to guess when you're thinking about diversification, which is pretty encouraging. So how
And
does
here
this?
too, where it's like here's a market like emerging markets where we've seen it's like, oh man, S&P, S&P, S&P.
Mhm.
This is that reminder, whether you're in your 401k, whether you're investing outside of that, it's like, oh, have that rebalancing tool on
Yep,
and be sure to include some of these other markets that this is a great year of reminding all of us of, okay, we need that diversification outside of US.
absolutely, absolutely. And yeah, just on the topic of like kind of that guesswork, and this is where ultimately like we're going to tie this to Messi, we're going to tie this to Argentina's
Mm,
big win, we're going to link it to the World Cup. So we're going to go back to the beginning of the week. Right now we're recording, it's the 16th
yep.
of July. So World Cup, there's four teams remaining. We got France who played Spain on Tuesday. We got England plays Argentina on Wednesday. And so we took a look at what were the odds of each team winning. So a popular tool that people will look at for a prognostication standpoint or a gambling standpoint is something called Kalshi, where you could see the odds of different teams winning. And so France was a clear favorite at 40% odds of winning the World Cup, not just their match earlier this week, but the World Cup, 40%. England was next at 22%. Then you had Spain, 21%, Argentina at 18. So sitting on the couch, it feels like France is a sure thing. Not a soccer fan, love the World Cup, love America.
Mm,
Our team's gotten really excited about this.
yes.
And so we've
Brackets
done,
everywhere.
yeah, brackets on the taped on the wall. Maybe we'll share a picture of that. Uh, but England was a safe choice. But the two teams that were expected to be standing at the end are no longer. The two safest were out. Spain and Argentina move on, some big victories. And so the bracket, the tournament continues without the favorites. And so what I think like the key takeaway here, whether we're talking about markets or whether we're talking about World Cup, is like don't confuse the current favorite with the eventual winner.
Mm,
And so in the same way, like don't confuse like current market narratives with a permanent truth. Narratives will change, leadership will change in the markets, but the markets can still go up. And I think about like how the stock market continues in the face of many things, continues to be undefeated. And I think again, like that's the great thing about diversification. You don't have to bet the whole couch on France.
yes.
We can own the entire tournament in this.
What that makes me think about, Will, is, I think a core text of us kind of growing up in the markets is The Big Short. And
Yeah.
and I think about just those charts of a guy like Michael Burry that over the
Yep.
years it's been like, oh, here's this very right one time core
Yep.
core piece in a book movie.
Yep.
Shout out Christian Bale. And then but then it's a, oh, okay, we here's another prediction of downturn. Here's another prediction of downturn.
100%.
Rich Dad Poor Dad. Was it Robert?
I always get his name mixed up
I know.
with
Yeah,
like another
we'll stay
famous
there.
author's
But
name. Yeah.
those charts are just downturn prediction, downturn prediction, downturn prediction. So, I think that it's similar to World Cup and just being like,
Yeah.
here are the odds, here are the people that you're listening to.
Yeah.
But let's use facts and outcomes as opposed to that.
Absolutely. Yeah, I wrote a piece recently just about like for our blog here about like I hope you're wrong. Like
Mm,
and that's just my like I hope if someone's making a bet on the World Cup and they're like on Kalshi, like I hope they get it wrong. Like I hope they
mm,
thought France was gonna win and Spain gets the win, right? Because like that adds a dose of humility to the investment space. That adds a dose of humility to our ability to predict the future, which I think is good. So, yeah, that great first segment here. Andrew, maybe we could pivot off to more of a Northwest centric topic.
let's do it.
And I know like when I talk to you, like you are in the space where like you've got some good stories, you've got some good like thought process just around like local housing market, and that always seems to be of interest to you. So maybe you can kick it off. Talk to us about Portland, Oregon, Pacific Northwest housing
Yeah.
market. What are you thinking about? What are you seeing?
Okay, I'm going to start what I'm seeing today with a little bit of what I was seeing a year ago, and
Okay.
just a personal, story of learning from me, and also provided some relationship to, I think, what our clients go through or what people go through when they're thinking about big financial decisions.
Hmm.
So, our family, we moved a year ago.
Okay.
We first time putting a house on the market.
Okay.
And I got caught in just information overload. And this was so spring of last year, trying to not time the market, but just thinking about when are
You
we
were
going to put
trying
our
to time
house
the
on the market? When are we going to do this?
market.
And what's happening is that if you allow your news feed to do this, you can just
Yeah.
get system overload. And so I'm reading articles about, it's so funny to think back on this, about how, oh, here's Texas and Arizona and where their housing market is going, and how
Mm.
seasonally, because their temperatures are ahead of us, like
Yeah.
these housing market narratives are going to swing their way up towards the Pacific Northwest. I'm like, oh gosh,
Mm.
like I got to do this now, because it was basically overly too much inventory. Things aren't looking awesome. And, we were fortunate enough to like get our house on the market and have an offer and be able to sell it, which was great. But I personally got caught up in some of that noise and some of that narrative. And so
Yeah.
it allowed me to relate to conversations that we're having with investors, whether the big decision is, when am I going to retire? And you get
Yeah.
caught in this like, oh, here's all these different things that I need to be thinking about. What do I need to do? Whether this decision is, how should I invest my capital?
Yeah.
And it resonated with me about how to go about making choices like that.
Mm. Yeah, I like that. I mean, like from my neighborhood, like like I've been consistently on Zillow just for fun.
Yes.
Probably not more than the average person, but I'm a power user. But I even just like looking in my own neighborhood, just seeing like some of just like the homes that are on the market, like to see
Mhm.
what the Zillow value is, to be able to see some of the fluctuations, but also just seeing how it seems like more homes are sitting on the market for longer at this point. And I'm curious if that's something that you're seeing as well.
Yeah, so I think that there's a couple data points to that, when we get to be a sounding board for folks when they're selling their homes, or just even within our office. And, you know, what some tools that we looked at in the past is just, okay, median days on market.
Hmm.
That's, trending up. We're at, in Oregon, we're at 42 days per Redfin. The other thing that's interesting is is looking at inventory year over year. So
Yeah.
I'm looking at a chart right here that's talking about, from 2021 to 2026, you can see the seasonality.
Mm.
So this dark orange line that I'm looking at here is like, oh, here is your 2026 inventory. We'll post
Mm.
this in the show notes for listeners. Is that comparatively to 2025 to
Mm.
2024? And you can see just inventory continuing to rise. And so one thing that I think about is, okay, well, how do we put that into context? And I mean, ultimately, I think the thing that through my experience and talking with folks is that, real estate is not only like a local topic, but it's like a
Mm.
micro economy, like per neighborhood topic.
Yeah.
And so a tool that I came across, no free ads, but this is like, I just feel like I've lived here the past couple of days, is
But if
called
they want to sponsor the show,
yeah,
right?
yeah, no,
We're
we're
open
not
to
against it. We're not
it.
against it. It's called Parcel, Parcl.
Okay.
And it's been this really cool tool that is looks at things. And I'm looking at this right now. It's just this like heat map of the United States.
Mm.
And they created this thing called the National Motivated Sellers Index, which is ultimately looking at, on a county by county basis, here's what the United States, and then zooming in on Oregon, like
Mm.
how motivated are sellers today as opposed to, history. And they're looking at things like, what's your percentage of homes that have cut their listing? How many
Mm.
days are homes on the market? What's the percentage of homes that are going and saying, I'm asking below what I purchased this for, and I'm trying to get out of this house? So from a Pacific Northwest standpoint, here I'm looking at the United States, I'm gonna pull up Oregon, and it's an interesting tool that I feel like that people that are, whether it be interested in just local housing, are thinking about buying, about thinking about putting their own home on the market, where you
Yeah.
can say like, okay, Multnomah County, we have. Let's see here. We're at 44% price cuts right now,
Wow.
which is, I think, is just an interesting anecdote. So I think as we're going into this like later season in the summer, and this is, whether it's you're looking on the upper end of the market, the medium part of the market, or lower end of the market, that's going to be meaningful and impactful. And that's kind of what's happening nationally too. I feel like that
Mm.
Oregon specifically, whether it be Deschutes County, whether it be Multnomah County, Deschutes, we're looking at 46% price cuts. So there is a
Anger.
motivation from a selling perspective, and I think that people have found themselves like kind of coming out of this 2021, 2022,
Yeah.
really ruckus time in housing to where we're at today.
Mm. When you say 46% with the shoots, is
Yeah,
that saying that 46% of houses or listings have cut their price?
correct. Yeah.
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 Interesting.
So, and we you can tear it out by, oh, here's what it is over $1 million. Here's what it is between
Yeah.
750 and a million, et cetera. And it's just been a cool tool to be able to see like you know, the name of the index, what's motivating sellers, and
Hmm.
how is that impacting from an inventory perspective too.
Yeah.
So yeah, I think it's just a learning from our families situation and my own decision overload a year ago to
Yeah.
today, that this is very much a run your own race. Like keep your eyes on your own paper, but
Hmm.
also be informed, I think, by some tools that can help you just to recognize that, oh, okay, inventory is very different today than it was in 2023. And I think that
Hmm.
both of those things can be true
Yeah.
when looking at what's happening in local real estate.
So you're telling me I shouldn't necessarily anchor to my Zillow estimate, right?
I think that let's use that as a data point as
Yeah.
opposed to all in.
But I do think that's hard, right? Whether we're talking
Yes.
about a house or a portfolio, right? Is markets ebb and flow.
Mhm.
Over the long term, they've gone up, right?
Yep.
Traditionally, I know that housing markets have been closer to inflation. In the last couple of years, it's been a very different story with houses, right? Where we've seen houses values skyrocket. But yeah, even with portfolios, is we're talking about like it's easy to see, okay, Micron got up to X amount of dollars per share, right? Like I should have sold at that point, and now it's
Mm,
down. It's like, well, you're still almost 10x from where you were a couple of years
for
ago.
sure.
So, right? And so a lot of it has to do with just like that perspective. And
Yeah, going
sometimes
back
it,
to our episode a couple weeks ago from SpaceX, right? Where
yeah,
it's like, okay, here, try and I think moral of the story, portfolio, real estate, neither are market timing based.
yeah.
Make life choices, make long-term planning choices, and ultimately, if like ideally with real estate, you're making a much longer term decision where where the
Mhm.
market timing piece is going to kind of be a moot point.
Correct. Correct. Yeah. Yeah. Not market timing, but I think there's like an opportunistic side of some of that. I think also think there's hey, this is not a good time to sell. I think a lot
Mhm.
of that has to do with like getting out in front of it, building a plan around what's next. And I know that you and your family were looking to transition and buy a home for a while, right? So you guys got to be a little bit patient there,
Yeah.
and had your own journey there. But no, run your own race. Love the connection to the housing market and the financial plan. Um, so yeah, it'll be interesting to see with interest rates moving, what that does for markets, specifically the housing market and what's next there. So I will get back on my Zillow and I'll check back in soon.
Okay. Okay. We'll calendar invite for the two of us for 3 months from now.
There we go. I love it. Love it. Um, well, yeah, and then yeah, maybe we can pivot here a little bit more and maybe think more just like investor broadly.
Mm-hmm.
And I know that you did some like great work on just like being able to take a look at a specific timeline and ultimately like why timing matters from an investment return standpoint. Do you want to walk us through what you're looking at there?
I do. Yeah. So this is not. This is somewhere between a cherry-picked example and a chart crime
I'll take both.
but for a really specific purpose.
Yeah.
And so, these charts and kind of this, as we've been presenting to different groups around town, this came from just a decent number of people. The conversation would go something like this, Will, where it's like, "Hey, I'm X amount of years away from retirement, or I'm retiring soon. Let me think through how can transition into retirement."
Yep.
And it was okay, well, let's look at your asset allocation. Let's look at your cash flow, all the different things. And we'd come across a significant number of people between 55 and 65 that invested in 100% equities.
Yeah.
So per target date fund glide path would say you're over indexed towards growth or equities.
Yeah.
For some folks, could make all the sense in the world. For
Hmm.
others, maybe not. Plan dependent. And so what I wanted to be able to show them was that, okay, like that could be you have benefited from this time period where that has worked.
Yeah.
And so, we'll use the phrase like good process versus lucky result.
Mm.
And maybe it was a little bit of both. And so what the chart that we're looking at right now, let's kind of overview the scenario. Somebody has $1 million, okay? And we're going to use this base case of them withdrawing about 4% of their portfolio per year. And we're going to say inflation's running at about 3, just for the sake of the example. And what we're doing is we're looking at the dark blue line
Hmm.
is you retired in the year 2000 and you experienced the market being 100% invested in the S&P 500 from the year 2000 to the year 2019.
Okay.
You're going along through each year, you're taking your money out, and the cherry picking example comes from like the beginning of that time period is brutal.
Yeah.
Pets.com is no longer a thing, Will, in case you were like we're in that era of time. And then you go through some more time through like 2005, 2006, and then you get
Yeah.
to great financial crisis, right?
Yeah.
And then you're able to go through and get some positive returns. That person ends up with about $360,000 at the
Mm.
end of that example. And then what we do is we go, okay, reverse, right? Here's this same example, but we're going to start this person in 2019 and we're
Mm.
going to work backwards. Okay, what happens if you had $1 million in 2019 and then
Yeah.
your return sequence is 2018, 2017? That person ends up with $1.95 million. Massive difference. They average the same rate of return over that time period, but they just switch the sequencing. So this is sequence of return risk is
Yeah.
is is the moral of the story. And it's people are really surprised when they see this, and we'll get some folks where it's like, oh, I'm just I'm gonna withdraw less when the years are bad. I feel like that's living in a model versus living in real life.
Yeah.
What's been some of the conversations that you've been having with folks around when they think about asset allocation as they're getting to this point in time?
Well, yeah, I mean, it's hard to be not excited about stocks in general. As you
Mhm.
see a couple of blips like 2020, where we see the market drop by 30, 33, 34%, and then pop back up and skyrocket to all-time highs. And to see a couple of these quick downturns followed by big rebounds. I mean, these charts, yeah, are great because it takes a real situation and highlights the challenge it is for somebody who's going to need to lean on their portfolio through bad times, right? It's a different thing, and the sequence of return doesn't necessarily matter if you're looking at somebody who is saving well in their 401k and making those
Yep.
consistent per payroll contributions, right? As you see a dip in the market and there's a buying opportunity, right? A systematic buying opportunity. But if you're systematically pulling from your portfolio, well, the last thing you want to do is violate that first rule of investing. The first rule of investing being buy low, sell high, right?
Mhm.
And doing the inverse. So if you're all equity, which like me, self-proclaimed, I'm an equity zealot. There's a book on my bookshelf behind me that's it's called Stocks for the Long Run. Great
Mhm.
recommendation. More of a textbook than anything else, but a great purchase. But what I would say is that when it comes to sequence really matters for retirees or
Yes.
someone who needs part of their portfolio to live off of. And it really is like the data would tell us, and I look at this in the classroom when I'm teaching the retirement planning course that I teach out at George Fox, is as you're drawing closer to retirement, you do want to reduce your level of risk. And then there's almost this like V shape where like you want to lower your risk. And if somebody wants more stocks down the road, great, right?
Hmm.
But there really is this period of time, couple years leading up to retirement, years leading after retirement, where you want to be more conservative because it can be this like catalyst for, unfortunately, like setting you up poorly for future results. And so a lot of it is like, yes, you can own stocks. Will stocks be undefeated in the future? Absolutely. Will there be bouts of it going down? 100%. Time tested. And so whether we look at it from an academic standpoint or I like this, just the practical timeline
Hmm.
of what it looks like for a 100% stock portfolio is really good to look at.
So part two is we go and we say, okay, we're going to use the same example, but we're going to
Hmm.
go with your classic 60% equities, 40% bonds.
Okay.
And what happens is with this specific example is you don't lose a ton of upside as we're looking at the chart here. If you have that inverse part of your return where you start in 2019, you go to 2018, you say, okay, you went from 1.9 million to 1.7 million. However, the actual person who retired in 2000, pets.com fails, go through
Yeah.
great financial crisis, that person has their portfolio go from 360 to 964, which is huge. And that's
Yeah.
just that downside protection. And
Yeah.
so it's really hard, especially coming out of this time period for folks who have been maybe overly aggressive per their maybe how they should be to say,
Yeah.
oh, I'm gonna make a tangible choice to be a little bit more conservative investor, but I think that it's, put the plan together first. But I think it's worth it from the standpoint of being able to say, okay, those first 5 years, those of leading up to retirement, those 5 years of your retirement, that's, some of us have called that the Super Bowl of cash flow and financial planning.
For
But
another podcast.
it's
Yeah.
it's an important conversation to have, and it's really hard to do when you've had so much success, most likely
Mhm.
doing it the way that you have been.
Yeah. The recency bias is strong right now. But it's good to know that like a well-diversified plan or maybe an intentional or resilient investment portfolio makes a ton of sense for somebody who's making big life changes like retirement
Yes.
planning. So,
Yes.
um, so I love this.
Okay, well, everybody's been waiting for it. We're to our last segment where we're talking about local recommendations.
Which can I note
Um,
something before we dive into it?
yeah, please,
It
please.
was really encouraging earlier this week. You and I were talking to a mutual friend, and they said, "Hey, Will, I took your recommendation, local recommendation, and yeah, going to the park, gonna ride bikes, gonna grab ice cream." So it's fun to see all that come to fruition. I believe that was episode 2. So if you want to check
Yeah.
it out, that recommendation is great. So people are catching on. There's a movement.
There's a
Uh,
movement. I haven't gotten the same note about stopping and getting the drinking water on the way to the beach, but maybe that we need, we need our own Gmail so people can go and
Like
send that
that.
in. So more to come there. But yeah,
Mhm.
we're changing lives.
Yeah. Speaking of changing lives, if you've got little ones and it's hot, my next recommendation is another state park. So
Okay.
Shampoo State Park a couple weeks ago. Now we got Mila MacIver State Park. So 90-degree day, 2 dogs, 2 kids, all panting. What I did is we took a trip to the state park, brought a couple inflatable paddle boards, and there's a dam there, and so you can put it in the water and play around out there, which is safe. And so not there's no rapids at that place. You're not below the dam, you're above the dam, and so kids are out there having a good time. Even my 5-year-old son was trying to figure out how to paddle out there, and it's pretty comical. I will say it is a state park. Probably leave the dogs at home if I was to
Okay.
replay that
Okay.
one. I think as on a solo dad day, I bit off more than I could chew, but we had a great time. My daughter, who's the 9-year-old, she was cruising around out there, and we both jumped in, had a good time. So, big Milo MacGyver State Park over near Estacada, right on the Clackamas River. Good paddleboarding. So that's my recommendation for this week. What do you
No
got?
traffic from Portland Metro. We're like 45, 50 minutes out.
Yeah, probably 45. I think that's safe. I think it's safe.
Okay. Okay. That's it. That's a good one. Never been last,
Yeah.
but the with the stand-up paddleboard, that's clutch.
Yeah.
I'm gonna go a little closer to home.
Okay.
We're going Westland, Oregon.
Okay.
My oldest has gotten into bird watching.
Okay.
We're birding. Put a bird on it. And this is actually comes from our neighbor Helen, and
Okay.
probably not a listener yet. And
Shout out Helen.
they're very into like their trees and kind of
Yeah.
they have a bunch of trees in their yard. And we were talking birds with her, and she's like, you know what? There's a place a couple miles of here, Maddox Woods, where this is in Westland, and you have the ability to go to Maddox Woods, and you have this little like lookout that goes where you're looking across the Willamette River to kind of this Clackamas Rapids area, as I'm looking at it on Google Maps right now. And it is a large blue heron like nesting ground.
Oh,
And so get the binoculars out. We actually saw two bald eagles just like chilling in one of the kind of dead trees there.
okay.
But I mean, we could see tens. There are hundreds of blue herons just chilling there.
Oh,
And
cool.
really cool spot if that's something that you're into. We were able to hang out there for a little bit. There's cool hiking trails. You can walk up to the library. There's a hiking trail for that too. So fun. Like I wouldn't say full day, but just
Yeah.
like looking to kill a couple hours and check out some birds. That's a good spot.
Maddox Woods, Westland, Oregon.
Maddox Woods, Westland, Oregon.
I love it. I love it. Uh, should we tell them about what we did earlier this week? The little bit of surprise.
I think we have to, and I think we can throw like that's the our first two recommendations are the okay, here's a version of like normal. We showed up to something that we didn't really know what we were doing and went to a bougie abnormal.
Yeah, bougie abnormal is, I think, right. So you and I and one of our other partners, Mark, get invited by a good friend and listener of the podcast.
Mm,
Shout out Mike Curry. And so went to something called Outstanding in the Field out in Carlton, Oregon, which this was sponsored by the restaurant The Ground out in
yes.
Carlton. And so picture a large table that could seat 75 people out in the middle of a garden where you could see the lettuce growing that you are about to consume. You could see the tomatoes ripening. You've got the birds chirping, creek going by, and we got to have a four-course meal, five-course meal,
Lost count.
lost count. Some of the best food, great company. I got to admit, the whole time I was like, felt like I was somewhat cheating on my wife from the
Yeah,
perspective of like she would have loved to be
I
there.
know. I know.
But here I am enjoying it with three other guys and 75 of my closest friends. So, uh, no, it was a great time. We stumbled upon it. And so good to be out in Oregon country. A great drive out there. I don't know if it's as much of a recommendation because this was a one-stop outstanding in the field made in Oregon before they
Yeah, I
moved
just
on
feel
to
like
a
we have to
different
say
state.
that it happened.
I know. Almost
And
almost as a maybe a humble brag or not so humble brag. So
I'll give a shout out to our guy Justin,
okay.
who he was one of the farmers there. He was in charge of both the cattle and the garden.
Mm,
And he's more passionate about soil quality than I think anybody's passionate about anything I've ever heard them talk about. And so he gave the comment, the carrot that you're gonna have this evening is gonna be the best carrot you've ever had. And was talking about nitrogen levels of soil. I think
mm,
all of us walked away from there and be like, dude, I'm farming after this.
yeah.
Uh, and I'll attest. I'll
Yeah.
go, I'll say, Justin, you were correct. Best carrot ever.
The most carroty carrot ever,
Most
right?
carrot
Most
carrot
carroty
ever.
carrot ever. So love it. Love the recommendation. So Maddox Woods or head out to McIver State Park. Those are our two recommendations today. Thank you all for listening. This was a good sesh.
Yeah, good sesh. We'll see you next time.
All right. Thanks, everybody.